Joining me now is Amal Dargalkar. He's the managing partner at Chatham Financial. Amal, welcome to the show.
Good morning. Great to be here.
Welcome. So what storylines are you monitoring most closely heading into today's session, Amal?
Well, I think you highlighted a number of them, but one that we're paying a lot of attention to is the upcoming CPI report in just a few days on Friday. Of course, it's going to be a major input for some of the decisions that the Fed has to make next week. And a lot of our clients, which span a variety of different industries, are paying very close attention to those Fed decisions as they can have meaningful impacts on their capital markets and investment strategies.
And what do you expect we're going to see when that CPI data is released on Friday?
Well, I think absent some type of bombshell in one direction or another, the markets are expecting CPI to come out still north of the Fed's target. North of 3% is right now what most economists are expecting on the core CPI data. And I think that continues to put the Fed in a little bit of a challenging position. That said, it feels like the Fed is very much focused on the labor market and some of the softness there, which is, candidly, I'd say mostly good news for our clients. They are certainly rooting for another rate cut and lower interest rates across the board for the stimulative effect that it can have on the economy.
And speaking of it, it's widely expected that the Fed is going to cut rates 2 more times this year, according to the latest data. Do you think that that's the right decision?
Well, it's hard for me to say what the right decision is. I think the Fed is in one of the more challenging periods that they've ever been in, with declining employment and inflation still running a little bit hot. I'd say for most of our clients, though, they certainly are not just expecting those 2 rate cuts, but continued expectations of rate cuts into 2026. And that is driving what we've tended to see is, lower rates, 10-year treasuries right around 4%. And I would say most of our clients are expecting 10-year treasury yields to actually go lower over the course of really the next 6 to 12 months, which of course has an impact on long-term investment decisions.
All right. And how are corporate executives making decisions based on Fed outlook and interest rate policy at this time?
It's a challenging environment for them as well, Ashley, and it's not just the Fed outlook. That's somewhat positive, and you've heard from investment banks and saying that there are very large M&A pipelines right now, and we certainly see that on the capital market side as well, where most of our clients are taking an approach of focusing on the current environment and saying, if I'm looking to do any issuance, let me just take care of that right now rather than waiting for an uncertain future. But the other pillar of challenge that they're dealing with is, of course, for any multinationals, the macroeconomic policies from the current administration relating to tariffs and trade. That has been going on for a significant amount of time now, really the last 6 months. And to some degree, I'd say most of the CFOs that we speak with have stepped back and said, listen, we're not going to get clarity. We still have to run our businesses. We still have to make CapEx decisions. And they're moving forward in a world of a lack of clarity because investors really are expecting them to continue to make decisions in this environment.
And given the lack of clarity and the volatility, how are you advising your clients right now when it comes to navigating the market as it is?
I think a few things here that are interesting to talk about, Ashley. One, on the interest rate side, I'd say there's a significant focus on take advantage of what the market is giving right now. So that could be, all-time low spreads on investment grade and phenomenally low high yield issuance rates. May as well take advantage of it if it's here, rather than waiting for maybe a even better window, 3 months, 6 months from now. Secondly, on the FX side, we have seen rapid movements in the dollar. I know you've talked about this before with other guests, and we'll continue to be talking about it for a while. One of the things that we've really highlighted to our clients is let's not get complacent here. And a theme that we have seen over the course of the last few months is investors, real asset investors, real estate, private equity, infrastructure, private credit, firms that had not really been hedging for some period of time here have started to increase their hedging activity on the FX side. And it's less, call it a sell dollar story or sell America story, and it's much more of a, we just need to mute some of the impact of FX movements on our returns.
All right, and is there anything that might be under the radar right now that you think will get more attention as we go on this year?
Yeah, I think last week was interesting to see some of the stories of, when you put together all the stories of some of the credit focused firms that were out there that are impacted by some of the bankruptcies and some of the weakening credit quality of certainly the lower tier of the American consumer. That is something to really pay attention to. We have in some ways a two-track economy right now in the U.S. Wealthy consumers are doing phenomenally well. They continue to spend. Every firm is looking to find out how they can tap that market. But as you go lower down into the socioeconomic spectrum, there are very real challenges, and that's something to keep an eye on in terms of its impact on businesses and ultimately, credit markets as well.
All right, thank you, Amal Dargalkar, Managing Partner at Chatham Financial.
Thank you. Great to be here.